Hey, I guess uh, uh, it's already 11:05, so I guess we can start. We have a lot of people joining in already. So first of all, I would like to thank everyone for taking time off on a Sunday morning to hear us speak about stock markets and discuss about stock markets in general. So I welcome all of you to this stock investing meet by Eastern Capital. So my name is Pratik Karmakar. I am one of the co-founders of Eastern Capital. I'm joined by Diven Sharma and Vinay Arya, who are also the co-founders. They are joining from another other location. So at Eastern Capital, we advise individuals in equity investments. So our style is mostly buying growth stocks in in trending sectors and holding on to them till the trend plays out. And we try to time our entries and exits in particular stocks so that our return is maximized. At the core of our strategy is a bunch of risk management processes as well. So, for example, we don't exceed, basically, we don't lose more than a minimum amount of capital in a particular stock. So our risk in our respective investments is let me mute everyone first.
It appears some people are having problems listening to the audio.
Let me mute. Right. So I was saying, so basically what risk management entails when we talk about risk management. So we do not, so our risk is capped at a very small number, let's say 0.5 to 1% of our portfolio in a particular investment. We don't exceed our total risk in a particular sector as well. And in terms of portfolio drawdown from the top, there is a cap there as well. So all of these strategies, risk management, buying into growth companies in good sectors, and timing our entries and exits has helped us give a very good return above all indices. So we started in April 2019. So till date, from April 2019, we are at a 125% return, which translates to a CAGR of 54%. Right. Apart from this, we also trade in hedged option strategies in our own portfolios and in our proprietary portfolios. So the purpose of these meetups was so we kind of end up working within the three of us and the four of us in our team, and we kind of don't meet with the larger investment sort of fraternity in general. So we thought it might be a good idea to exchange some ideas, clear people's doubts and questions, and hopefully learn something from each other along the way. So I have spoken a lot, so I'd like Diven or Vinay to say something.
Vinay, you want to go first?
Yeah, so hi everyone, I am Vinay. So as Pratik said, the purpose of this meetup was to chat up with the investment fraternity in general and to listen to and address with the kind of concerns that people might have. Primary one being that is being discussed every day these days is that is the stock market too high? Is it running too ahead of fundamentals? Because that is scaring a lot of people still to be thinking about investing into to come into the Indian market and to start investing. So amidst all the other things that we will be addressing, this will be one of the one of the key things that we would be addressing during the meetup.
Right. So one piece of all right, Diven, continue.
Yeah, no, I was just saying as a third part of the trio of Eastern Capital, but I think there are some housekeeping issues. A few people are not able to hear the audio, it seems. I wonder if it's related to settings.
I think everyone is able to hear as of now, so I have seen a few replies.
Yeah. Anyone, if they're not able to hear, please can you ping on the message board again? I saw a few replies. We'll see if we can help sort that out. But yeah, again, part of the trio of East Green Capital, and as Pratik and Vinay mentioned, our strategy is to follow trends in the larger equity markets, but also keep a view on the fundamentals. And with a very disciplined risk management approach, we want to outperform the market as we have been doing since our inception. The trick here is to provide risk-adjusted returns which are sustainable and which continue despite the market going up and down. So that's kind of our critical objective as far as our investment advice is concerned. So I'll pause there, and we can begin our discussion. We can start with a few questions that we received earlier on, or Pratik, if you have any on the message board already, we can start addressing them.
Before that, I would like to put out a disclaimer first. So since most of you are not, since most of your portfolios are not being actively managed by us, so whatever we say or do, so just don't go out there and buy it, because you would never know how or when our opinion can change. So we might be positive on one stock, on one sector today. We might be having them in our portfolios. It's possible. But tomorrow, if things change, our opinions change, we can sell or short them anytime. So just be aware of that. Since we can tell our clients or our investors as to when to sell or how to sell or what to buy. But since most of your portfolios are not being managed by us, so that's something you should be wary of. Right. So about the how we are going to operate here. So you would see some sort, depending on the device you have joined, you would see some sort of ask a question icon somewhere. So let's say you're from joining from a mobile phone or from their app. You would see sort of a call out on the bottom left corner of your screen. So if you're joining from the web platform, you would see some sort of a call out with 3 dots. So just hit that button. You would get into the Q&A queue, and then probably we can take questions one by one. Right. So we have a few questions. So we can start taking them. So right, the first one is from Pranay Agarwal. So your mic is unmuted now. You can ask. Hi Pranav, can you hear me?
Hi. Sorry, actually I clicked on it by mistake. I do not have a question.
All right. I will take the next question then. All right. Hi Divya Punj. You can ask. Your line is unmuted.
Hi guys. Nice to see you.
Hey,
hi. So
nice to see you. It's been a while.
Yeah, a long time. So quick question here is a couple of housekeeping questions. Question number 1 is, are you SEBI registered? And that's question number 1. Should I ask all my questions at once or one by one?
So that is for short answer. Yes, we are SEBI registered investment advisor, so you can move to the next question, I guess.
Okay. So the second question remains here is that, say, if somebody wants to invest with you, typically like my mom or my other friends who usually invest in a mutual fund, so would you have, because on your website I see that you would probably give out a model portfolio and people have to replicate it within their own demat or within their own stock brokerage account. Also, a little more clarity on how it currently works and how it will work in the future, if what your plans are.
So how it works is, whenever someone joins and goes through the typical processes, so they are given a risk-adjusted model portfolio. So from day one, since the market are so elevated from the mean, you would not get the entire model portfolio. You would get all the stocks, but you would get risk-adjusted allocation. So you might end up having 15 to 20% cash at the initial stage. After that, you need to replicate that portfolio in any demat of your choice. according to the allocation suggested. And then you are sent changes over email, whatever buys and sells we have, and the same are updated on the website as well. So that's how we work.
So just to add here, the idea is to efficiently rotate the portfolio while always taking care of the risk that is there in each and every stock that we are looking to pick.
Right.
So this is the part which I'm trying to understand, is that what kind of an investor would fit this profile, because eventually the investor would have to execute the trades on their own, with their own broker at this point of time.
Yes.
Right. But there are, so let's say someone is not willing to go through the entire route of doing it manually each and every stock. So we are present on a platform called Small Case. So there you have a facility to buy everything or change everything with a single click.
Got it. So they can use small cakes and
right.
Got it.
So for execution, there are a couple of other efficient modes also.
Right.
That again, so that is like dependent on various. What kind of an investor is are we addressing? So that would depend on that. But yeah, largely these are the two modes that are there.
In the future, would you, I don't know when it will happen, maybe you don't know, but do you have plans for going the mutual fund route, like people can actually transfer their cash to your organization and then you can invest it as an aggregate, somewhat like a mutual fund would do?
Not exactly a mutual fund, but we are looking to get a portfolio management services, which is a PMS license within a year or year and a half. So that's the route we can take it today as well, but we are yet to meet the regulatory initial requirements. So we're just waiting it out.
Yeah.
So just if I can add, just the process of getting that through with SEBI, and in the next few quarters or so, we're likely to meet that requirement. So you'll have a PMS, and then it becomes easy to invest, as you're saying.
Right.
Yeah, because a lot of people I think who can invest with you, and given your really good track record, so those are those people who would not be in a position who can trade on a daily basis, or who can actually, many people would not even bother to access their emails also.
Right. And in fact, it's not that frequent as well, so we don't change our portfolio daily. So it's more of 2-3 times a month, and not more than that.
Yeah, nowadays market has become so volatile, because if you don't do it on the right time, you might not see any returns at all even, because the stocks have run up.
But that works both ways, right? So after you are given a recommendation, you might be able to get it at a cheaper price as well after a day.
I agree.
Yeah.
But it is always best left to professionals like you who know how to do it all pretty well.
Right.
So pretty much that ends all my questions. If I come up with something else, I'll get back.
All right, sure. We'll take the next question now. Hi, the next question is from Mitali. So your line is unmuted now.
Yeah, hi. Thanks so much for holding this session. So I think I also have two questions. One is that I'm someone who's not invested as yet. So I want to know how much do I should know enough to start investing. And the second question comes from our previous discussion. We have portals like Zerodha and also the Small Case. So if I, as an individual investor, I just go on Small Case. So where do I place you guys there? So is it just the suggestions that you guys would give, or there be more to it? Yeah, that's about it.
All right. So was the question about finding a profile from Small Case?
Yes. So see, as I said, so I haven't invested till date. So I'm someone who's very new to all of this. But the first doubt that I get is, do I know enough to do it on my own? And now because Zerodha and Small Case kind of portals are there for me to do it and not to get in touch with someone who's in the middle. So yeah, so how much should I know to, start doing it on my own? Or should I take help from you guys? Is that the place where you guys come in, or somewhere else? Yeah.
Yeah, for sure, we can help out with execution as well. Anyway, it's really easy to access and use these platforms. So there are different help portals created by Zerodha and Smallcase themselves. So even if you go through it and spend an hour on it, it's the user experience of these platforms is so top-notch that anyone can start using it after reading it for half an hour or an hour. In any case, we can always help you with the understanding after the call or whenever you want to get in touch.
Okay, and how do you guys help? Is it just the knowledge bit, or there's more to it? Yeah.
Yeah, so I think there are two parts to your question, Mithali. One part is the operational part, like how do you use these platforms, etc., which I think Prateek has addressed. It's pretty straightforward. You can read up about it, and we are there to help you on that. The second part is actually knowing like where to invest and understanding this whole thing.
Right.
And I think your question was that where do we come in? That's precisely where we come in.
Exactly. Yes.
So we understand that a lot of people either do not have the time or they don't have the right knowledge or training to actually look at stocks one by one. So as Prateek was mentioning earlier in the conversation with the Vipunj, what we'll do is we'll construct a model portfolio for the investors. And then it's up to you just to buy them and sell them as we instruct you. And obviously we can help you go with that. So we do not expect investors to know deeply about these sectors or stocks. That's the whole idea of us being there to help you.
Yeah, this was exactly my first question, that how much should I know to get into this? Yeah.
So in terms of how much you should know, what you need to know and what you need to expect is to kind of temper your expectations when you start investing in the stock markets. So there are a couple of things that are really necessary to know. One is that stock market investments always have a certain amount of risk. But the second related point is that there are ways to manage that risk. So once you start understanding that with obviously our help, then you can kind of form a framework as to, yes, there is a risk in this asset class, but there are ways to navigate that risk. The second thing that you said, how much should you know? So you need to know what is the kind of allocation that you need to do to equities from your corpus or from your investable portfolio. So those are the two decisions that you need to take at your end. But once you have taken those decisions, we then come in to help you navigate through the entire complexities of where to invest, which stocks to pick, and how much to invest.
Even with regards to asset allocation, with regards to, let's say, a percentage of your net worth, we can help you out in that, because in that as well there are pretty clear SEBI guidelines as to how much you should invest. Rather, it's sort of a suggestion, not a guideline as such. And of course, taking into account your financial position, your liabilities, your dependents, all of those things can be done on a one-on-one session, I guess.
Okay. Thanks a lot, and all the best to you guys. Yeah.
All right, thanks.
Thanks, Mithali.
All right, I'll take the next question. Hi, the next question is from Joyce. Joyce, can you hear me?
Hi. Yeah. My name is Prakash. I'm Joyce's husband here. We are both listening to your commentary, and we are enjoying this session. I had this particular question. In India, or how do I put it as, we may get into a phase of very hyperinflation, say 10, 15 years if we have a war and things like that. Now, I was looking at a product, in a mutual fund product, where this particular risk is mitigated with gold as a hedger. Do we have a product in India where I can withdraw gold, physical gold, at the end of the tenure or whenever I want to exit the market? Or is it always cash? As in normal ETFs. Do we have a product wherein I can withdraw physical gold from the AMC? Hope you get my point.
Yeah. So does sovereign gold bonds have that facility, Vinay? Devin, do you know?
No, I've invested in sovereign gold bonds, and there is no such facility there as to
Yeah,
draw
I
gold as in this one.
Yeah, I highly doubt that there would be such a facility. Typically, what is expected is that an ETF or any of these bonds, they help you hedge through a given duration. And then you're expected that because you get the cash at the end of whatever tenure you have, you can buy physical gold at the end of that. That's typically how these work. And in the US, you would have heard of TIPS or trade or the inflation protected securities by the Treasury. These are all instruments that help you hedge. But I, for one, am not aware of any instrument that allows you to get physical sort of asset at the end of the tenure.
Yeah, one way
Okay.
can be
Okay.
taking a long-dated future and then taking delivery of the gold. You can buy a long future in MCX, I guess. That's
Okay.
one way, I guess.
Okay. Sure. Thanks.
All right, thanks. We'll take the next question.
Yeah, Pratik, if I may just quickly intervene here because it just raises an interesting point about gold because a lot of people generally ask to invest in how much to invest in gold, should they invest in gold, and how to see that. And with all this craze around Bitcoin and all of that, it also brings up this question. So just to preempt that, if you listen to all the great investors and if you look really carefully at gold, as was just pointed out in the conversation, it's a hedge. It's not really an investment. So gold is a metal that we humans have been using for millennia, and we all trust it for some reason because everybody trusts it. Then there's value to it. So it's typically used in cases of scenarios where you expect a lot of inflation or you expect things going down, just like we saw in the COVID crisis where you saw gold prices going up. But that's precisely the use of this metal, this instrument. If you're looking for returns on a long-term basis, then gold really doesn't do anything, right? And if I would just use Warren Buffett's phrase, like a company generates profit, it does something. Gold sitting in my house doesn't do anything. So just laying this out there, it's a hedge. It's useful. We should look at it, but it's not exactly an investment.
It does not produce any cash flows. That is the precise reason.
Yeah.
And the value is all artificially held by a common belief of all humankind that this is a valuable asset.
Which, by the way, is true for all currency, including Bitcoin these days. So, yeah.
But at least the supply of Bitcoin is constant, and you cannot print more Bitcoin, right?
Yeah, that's part of the reason for gold as well, because the supply is extremely limited.
You are right to a certain extent, but supply of gold can come in the future as and when the value of gold increases, right? So the places we are not too economical to mine into, so let's say gold reaches or exceeds a certain price, those places would become economical to mine. So that way we can
That's true.
theoretically have infinite supply of gold. Because there is gold generated in neutron star collisions also, if you want to go that way.
That's too futuristic, but yeah.
Yeah. All right, we'll take the next question.
Sorry for intervening there.
All right, we'll take the next question. Next question is from Pranav Agarwal. So you can ask your question now.
Thanks for having this wonderful session. So I had a couple of questions. I assume you must have answered in part some of these. So firstly, I wanted to understand, like, do you invest only in equities, or is it that when you give some recommendations, is it a mix of equities and debt also? Firstly, and if it's
okay,
yeah.
Okay, so let me answer that first. So we invest in equities plus some at given point of time we might also buy into gold ETFs. Like when the situation warranted, like May last year, we bought gold ETFs in our investor portfolios as well. But we have exited that last year itself. So apart from basically whatever instruments are listed on NSE and BSE, we are able to execute that in our clients' portfolios. Also, the cash is whenever we want to raise cash in our portfolios, that cash is held in the form of short-term debt sort of securities, which are called equities. So generally, but having said that, we are majorly allocated most of the time in equities.
Understood. So the recommendations that you'll be giving to us will also be majorly in equities as of now.
Right.
Okay. Another question I had was that when you are looking at kind of the investment philosophy that you have, so I was able to look at your website as well in a short brief period of time while you were answering others' questions. Like it mentions that you look at both fundamentals as well as the trend analysis that is currently there. So is there any specific parameters that you have when you look at fundamentals, like in terms of companies also? Is it like only large cap or a mix of large cap, mid cap, or any cap companies, market cap companies would be there in your portfolio? Like, is there any demarcation that you have for less riskier investments or more riskier investments?
Okay, so first of all, let me address this misnomer that or a misgiving that many people have, that small caps are riskier than large caps. So there is no such demarcation or rule in the market that the larger the cap, the less riskier it is. It's not the case. The only thing that you can point out is that they may be less volatile than smaller caps, because obviously you need a large amount of money to move these stocks, these large caps, because they are traded in huge quantities. So only big institutions can move it. The only thing that matters when you are taking a stock buy decision is whether the company earnings can grow well into the future from today, and also whether the company makes an above cost of capital return every year. So these are basically the only two crude parameters as to basically filter out most of the companies what are traded in the Indian stock markets. So that's a bare minimum fundamental sort of filter that we use. Does that answer your question?
But so I would like to add one more point here. Having said all this, we do take care that we don't get into very illiquid small caps,
right?
Because there you maybe can enter, in the time of euphoria, but when the market starts to fall and there is all round negativity in the market, then the liquidity in those small caps actually dries out very, very quickly. So it becomes difficult to exit them because of sheer liquidity issues. So we do take care that we need to have a certain average daily liquidity or weekly liquidity in a stock if we are looking to enter into it.
Okay, correct. Understood.
Can I also add a small point to this? Just because you were earlier mentioning about the returns of the company, the quality of returns, as well as the growth. So just to clarify for everybody listening, it's not that we'll just look at two numbers and that's our fundamentals check. So what Prateek is suggesting is that everything goes into the management quality, for example, is something that we look at, and that obviously has a huge bearing on the returns generated by the company and the growth. That's just one example. We'll look at the amount of debt that they have, pledging of shares, etc. So all those things that you can think of. But essentially, I think what Prateek was mentioning is that all of these kind of inform these two big metrics, which is the return on capital employed and the growth of the company. So I think that's what he was mentioning, just so that you don't have any doubts that we're just looking at two numbers. That's not the case.
Yep.
Thanks for the clarification. Just one last question. I'm sure but you already mentioned that you look at all the stocks which are present on BSE and NSE. Do you currently or in near future, are you looking forward to, giving recommendations about global equities as well, like the US markets and all? Or is that something which is not in your current plan of action?
It is, but currently what the problem is, not a problem as such. So there are a few points that we considered before thinking that as of now we are looking to focus on India only. So one is the large amount of charges or expenses that people incur when they want to invest in the US. So first are the bank forex charges, right? So whenever you convert USD to INR, INR to USD, and then want to sell that stock and convert it back to INR, you straight away incur a 3 to 4% sort of a drawdown in your portfolio by courtesy bank charges. Basically, what your bank charges for doing the forex conversions. Second is this sort of a geographical diversification makes sense only for people with a very huge sort of a corpus, let's say 100 crore, 50 crore and above. The reason is this: basically below that there are enough opportunities or enough liquidity in the Indian small caps as well. So if you are holding a 10 crore, 20 crore portfolio, you can easily buy into, let's say, 500 or 700 Indian companies. The second part of it is the entire move towards US has been caused by recent factors as to how the FANGs have performed in the US. So the entire recency bias that people have, the investors have, they think that developed markets are the way to go, investing in tech is the way to go, and India will keep underperforming because it does not have any tech instruments or tech investments. But that's definitely not the case. India will keep on growing from here on, probably near double-digit rates. So and India will keep getting new tech listings as well with time, as and when the market matures. So I believe instead of going to US, the next big opportunity is present in India itself. But having said that, if you want to diversify geographically and you have a huge HNI-like portfolio, that kind of makes sense.
Thank you so much. Thank you, Parth.
Do you have any other questions? All right. So we'll take a few questions from the chat. Let me see. Okay. So the first question is, are you guys in active portfolio management, or do you provide the alerts to clients and clients have to act? So we do that. So we manage our portfolio actively. We believe in churning fast before things get out of control. To limit our investments up to a certain risk, up to a certain loss, certain maximum loss in a particular stock, and then the clients have to actively manage the portfolio. That you're right there. So the next question is by Mr. Arasu. He's saying that I'm a person of 70 years. I'm investing in mutual funds and shares for the past 25 years. Please suggest the best mutual fund in this volatile markets. Any strategy to follow? Right. So given your age, so it's obvious that you should have a mix of debt and equity in your portfolio. So since I don't have any particular specific knowledge as to the kind of dependence you have, kind of expenses you have, kind of liabilities you have, it's difficult to tell you the exact breakup between debt and equity. But on the equity part, so most of the mutual funds, if you look at large cap mutual funds or Nifty ETFs, so they would perform in line with market because of various reasons. So it's really difficult to point out one particular mutual fund which would be best in this volatile markets, because all of them would move lockstep with markets. Maybe some would move more, some would move less, but more or less the returns you would get in any mutual fund would be in line with the indices.
So Pratik, if I can add something.
Yeah, sure.
Here. I would recommend to everyone, including the gentleman who asked this question, is that if you want to have a more actively managed portfolio, then people like us could help you. But if you are looking for more of an index kind of a return, then it's better to just go for ETFs.
Yeah.
That's probably an easier route than going to mutual funds, because you incur less fees if that's really what's your expectation.
Absolutely. If you want a specific sort of discussion, in case you want to look at your asset allocation, we are free to help anytime. So you can just drop a line after the call and we can connect.
Yeah, that's true for everyone. Everyone on this call, we're happy to chat with you offline with any specific questions that you might have.
Sure. Okay, so Shubham Arora is asking if you want to recommend some good books for someone who is willing to get into investing. for complete beginners. So first of all, I believe you need to, so if you want to learn the very basics of stock markets without really getting into detailed strategies or how to trade actively, so I guess the best resource for Indian markets would be the entire varsity section created by Zerodha. So it's very easy to understand, very well explained, and it should do the job of doing the basic sort of education. If you want to go deep into specific topics, then there are other books or other resources available. But as a beginner, I mean, Zerodha Varsity it does its purpose, I guess. Karthik is asking, what is your take on derivatives? So obviously derivatives are a great hedging instrument. The kind of leverage, let's say you want to get into hedge derivative strategies. So the risk is anyway capped there. So the amount of risk you want to take in that trade. So that way, if you can hedge if you are willing to hedge your portfolio, or if you want to do hedged option strategies or hedged future strategies, so they are a very efficient instruments to kick up your return on capital. Okay, so the next question is by Krishna Kumar. So it's saying, for any retirees, is aggressive hybrid mutual fund suitable for lump sum investment? Okay, so again the same sort of answer that we had given previously. So for retirees, obviously, if you so basically your asset allocation needs to be right, and there is no blanket answer for everyone. Everyone has their own specific sort of situations. So the kind of asset allocation in terms of hybrid equity, basically a mix of debt and equity, can only be recommended to you after a detailed analysis of your sort of financial situation. So if you are going to invest in hybrid equities, then you're being at the mercy of the fund manager, right? So the kind of allocation he does for his fund at that particular point of time, so you have to accept that sort of allocation. So that's there. So basically the evaluation here should be as to whether you trust the fund manager or not, or whether he is good enough to do his fiduciary duty. So it all depends on the fund manager as to whether a particular hybrid equity instrument or is suitable for you. So again, it's totally a specific question with a specific answer. It's difficult to sort of put a number or recommend any mutual fund at this point of time. So next question is by Ankit. So he's saying, do you have a minimum capping in the portfolios which you handle? So we don't have a minimum, but because of technical reasons, so let's say we have a portfolio of 30 stocks, and since India does not allow fractional investing, so let's say the minimum let's say the maximum price of any of our stock is 6,000 or 7,000 a stock. You have to buy at least one stock of it in order to get that in your portfolio. So that kind of raises the minimum investment so that you are able to buy all the stocks that are in our portfolio. So that comes out to be around 2 lakhs or so. But having said that, so if you look at your asset allocation, you should have a substantial amount of your assets into equities. So if you are going with a small amount, so I don't think you would be able to see any difference in your capital after, let's say, even a few years. Hi, Subham is asking again. So I've been to Zerodha Varsity. He's asking what else can I consider reading after that. So Shubham, I would like to say, so it all depends on the kind of strategy road you want to take. There are plenty of ways to make money in the markets. There are tons of strategies. So it all depends on your personality and your thought process. And so from those sort of understanding, you'll be able to identify certain verticals. As to I want to be a master of this vertical, I want to be a master of this strategy. So All of those factors have to be taken into consideration before sort of recommending that you have to go and read this book or this master your studies in this area. So do you have any particular area that you have chosen or vertical you want to be great at?
Yeah, as Shubham is answering that, let me add something from my own experience in my investing journey. I would recommend, I don't know what's your background, Shubham, but it's really useful to understand financial statements, because that's going to be useful regardless of which part of the strategy book you want to play in. So again, I don't know your background, but if you're not very well versed with that, you can try to start educating yourself. That's like the bread and butter of this thing. So that's one thing. Then, like Prateek mentioned, it depends on which style or which type of investing you want to do. One thing that I'll recommend not to do is not to pick up one of those big books like The Intelligent Investor, etc. So I'm saying something controversial, but it's a large book and it's very dry. I've read it, so there are better ways to learn the same strategy. Just because it's the Bible doesn't mean that you have to pick it up as a beginner.
And it's questionable whether that works today or not as well.
Just to add here, so Shubham, there are two things that you would need to learn about if you want to start equity investing. One is, as these two guys have answered, that you need to learn about companies, and for that you need to learn as to how to do financial statement analysis and how to judge the growth prospects of a company. So that is at the company level, wherein you are looking to select which stock to buy. Another thing which you need to learn about and which most of the individual investors actually miss when they start equity investing is to learn about risk management, because that is something that is very, very important for an individual investor who has limited capital and who wants to grow his capital at a reasonably fast pace. So when I say risk management, I mean you need to learn about things like how should you find out as to what is the kind of exposure to take on a particular stock, and what is the kind of risk that you need to fix in a particular stock beyond which you would not be willing to continue in that stock and you would exit. Those are the small things which actually sound very very hygiene like, but are extremely critical for a small investor to learn about and start practicing. The combination of being able to do good financial statement analysis and to find out good companies along with good risk management is what makes for a healthy portfolio which compounds over the long term at a rate faster than what the index moves at.
In fact, you have to be a polymath to succeed in this industry. So you have to have knowledge of, let's say, economics. You need to understand financial statements. You need to know what's happening in the world. You need to have a deep understanding of probabilities and risk management. You need to understand what's happening in the world in terms of macroeconomics. You need to have a deep understanding of, let's say, derivatives, position sizing, asset allocation. So you need to be a polymath, including a deep understanding of human psychology and the entire mental side of trading and investing. So it's a tough field. You need to be detailed and thorough in all of these sort of verticals. Then only it makes a complete investor. So it's not just that you want to be the champion of financial statement analysis. So that would not take you anywhere in this field, honestly.
And that's what makes it so enjoyable.
Yep. The next question is from Divya Pun. So what is the ideal portfolio size to work on your recommendation? So obviously the asset allocation part is totally dependent on you. So firstly, you need to allocate a decent chunk of your net worth into equities, first of all. And then you may decide to hire or take the services of multiple equity advisors or not. Then probably that is the upper cap, that sort of portfolio size becomes the upper cap that you should invest. In terms of minimum, so let's say talking from only from a fee point of view. let's say you don't want to spend a large amount of your returns. You don't want to spend that on our fees. So let's say our fees are 24,000 a year. So above, let's say 7-8 lakh sort of a portfolio size, the fee as a percentage of your portfolio reduces to a near small single digit number. So that is the bare minimum you should invest if you don't want to see a large amount of your returns going into fees. Right. So Akshay is asking, what are your picks for long-term investment? So Akshay, first of all, firstly, whenever we buy a stock or we invest something, we don't buy that stock thinking whether this should be a short-term or a long-term investment. So let's say I have bought a internet company today. So we are hoping that it will end up becoming a long-term investment. But the reality is that we have to exit a stock within month or 2 months or so because of various reasons. So some of the reasons maybe the company has started performing, the company has stopped performing, the company has stopped growing, or some new risk has come on the horizon for that company. So after all these things are taken care of, only a few survive for a longer term. So when I talk about a longer term, a few quarters or a couple of years. So it's very difficult today to say as to out of these 25-30 stocks, which of these would survive in the long term. So most people go wrong here because whenever retail investors speak, they say, I want this for a long-term investment. Basically, the reality is no one really knows whether this is going to be a long-term investment or not, or whether this would end up being a short-term investment. As of today, I mean, in hindsight, we can always say that these ended up being long-term investments. You have anything to add, Deven or Vinay?
So
Yeah,
we don't impose the term of investment on any stock. Our endeavor is that maximum stocks should continue to compound at a fast rate for the longest possible term when we are looking to buy them. But the entire purpose of designing a portfolio of, let's say, 25-30 stocks is that even if not all of them continue to display those characteristics, there would be a number sufficient enough that would overweigh the stocks or the companies that would not do too well. And those are the ones that we need to quickly get rid of and to replace them with another set of healthy companies that are continue to again grow faster than at a reasonably fast pace. So as Prateek said that long term or short term, it's known only in hindsight, but the endeavor is to pick good companies that we can continue to hold for the longest possible term without violating our risk management principles.
Right.
Yeah, and if a company keeps on performing, the stock keeps on performing, we'll hold it for quarters, even years. So that's how it is.
Yeah.
I wonder if the gentleman wanted some.
It becomes very hard to pin down.
Stock-specific answers. So just a disclaimer here that we can't really do that through this forum in case that's what you were expecting.
Even if we knew, I mean, we don't know that, right? How would we know that 5 of these stocks would go well? I mean, we have selected 30, right? So we cannot pinpoint that these exact 5 would do well, or we end up keeping them for the longer time. So it's always a team.
Our wish would be that all 30 would continue to do well, and we are able to hold them and compound our money at a very fast pace through all 30 of them. But that is where, as Prateek mentioned as an answer to an earlier question, the rule of probabilities comes into play, and that is where the entire principle and discipline of portfolio design is something that helps in compounding our capital at a reasonably fast pace by the rule of sheer probability of a good number of companies doing well from our set of chosen companies.
Right. All right. So Aditya is asking how often you often talk about institutional money and one should invest where the institutional money is going. How do we keep a track of that? So there are plenty of ways. So the basic way is to look at the charts and look at the volumes of and the price action of the chart. So that is one way that one can do daily or weekly. Other sort of ways are you have to look at the quarterly shareholding that a company publishes. On top of that, there are exchange filings as well of that particular day. As so these are the big deals of the day, or these are the institutional buys of the day, which are called bulk deals and block deals. Also, mutual funds are mandated to publish monthly sort of their holding. So from that, you can gauge out the kind of buying and selling happening in which stocks and of what quantity. So there are plenty of ways. There are more tools as well.
There are a lot of online sources wherein this data is aggregated and it is available on a free basis. So if you just do a simple basic search, you would get to know that there are really good sources that are freely available for this.
Right. All right. We'll take the next question. So these are audio questions, I guess. Wait. All right. The next question is by SN.
Hi. So I had a very quick question regarding the compounding aspect. If I were to invest in a stock for, let's say, 2 years, then essentially the money isn't get compounded, is it? It's a linear growth that I'm expecting. So I'll give you an example. If I invested in Nifty Bs in, let's say, 2010, and I try to exit it in 2021, I would get around 150% of return. Whereas if I were to play around with Nifty Bs and then buy it and sell it and buy it and sell it, I would probably be getting higher returns. So is compounding only possible if you keep on playing in the market and keep on exiting a particular stock portfolio and then buying it again when it dips, or that's a question that I have.
So I guess both ways are useful for compounding, right? So you can expect and hold on to a particular instrument for a decade or so and hope that and take the benefit of compounding. That is one way. Another way is sort of what we do. We kind of want to maximize our returns in a particular time period in a particular stock. So we kind of compound by churning fast in our portfolio. So basically, let's say today there is one theme which is hot. Let's say, for example, today it is IT. So it may end up slowing down, let's say, for after 6 months or a year or so, and a new theme might emerge. So the idea here is you are able to get a better compounding rate than Nifty by rotating between sectors or stocks. Now, obviously, you have to get your timing right here, entries into stocks or particular sectors. So this gives us, if you're able to do it properly, this gives a kind of a fillip to your index returns. So this is like compounding plus in a way, rather than just holding on to one instrument.
Perfect. I just wanted to understand. So a lot of people talk about compounding even if you hold the stock for a very long period of time. But then that isn't really compounding, is it? That's a linear return on the investment that I've made.
So the compounding does happen. But the risk that is there is that if you are if you are trusting a few number of investments sort of blindly, like hoping them to continue compounding into the longer term without analyzing any implications with regard to as to where is the company's growth or where is the underlying assets growth, because you mentioned the case of the index in that context. The underlying asset would be the entire pack of Indian listed equities. So if you don't have regard for that, that is, I think, not an efficient way to think about it. But so when we say compounding, actually there are two ends of the spectrum wherein we can use either of the approaches. So something also depends on your behavior and your temperament. If you are someone who thinks about himself that yes, I can continue to enter exit continuously at appropriate points of time without fearing as to so whenever there is a right time to enter into the market, you can see that there is fear all around. So if you are someone who thinks who will be able to overcome that fear and enter at the right time, that is an approach wherein you can, hope that, I would be able to invest, let's say, on the 25th of March or let's say the 1st of April of 2020. But since that is also not practically possible for most of the investors, the right approach is to maintain a balance of the two, not continue to blindly trust an asset that it would continue to compound money for me, and also not be too much opportunistic, being able to gauge the exact bottom point at which to enter a stock and being able to exit at the, right at the top. So middle part is where, where the sweet spot lies and where you should continue to be present most of the times.
Okay. Yeah, I think when you were mentioning about compounding by investing in a company, that's probably what the great investors also talk about, like you invest in a company and it gets compounded. What they mean here is that the company management is using the retained earnings to do that, and they're growing the company, and hence your capital is getting compounded, and that's probably what the likes of all those great investors like Buffett, etc., will talk about. But I think I agree completely with Vinay. It's very clear in hindsight. Now everybody can say that if you had invested so much in Apple and Amazon, etc., then you would have made so much money. But if you go back to the 70s, look at the American markets at that time, the big companies at that time were the likes of ExxonMobil. And if you had invested money in ExxonMobil at that time, then your money would not have got compounded. So I think the realistic answer is the middle path, where you stay with the company as long as they are growing, as long as they're doing well, and they keep compounding your money internally through their good management and through using retained earnings for growth. And you also deploy your capital by shifting sectors or companies where and when required, and you do your own sort of action to enable that compounding. So I don't know if that answers your question.
It does. Yeah.
Basically, the idea is you have a bunch of stocks, let's say 15, 20, 30 stocks. So you have to evaluate all of them with frequently, right? So let's say you choose a frequency, let's say monthly or quarterly. You have to evaluate all of those stocks and then decide whether you want to sell one of those or whether something has stopped performing or stock has some disruption in the future. So those are the ideal points to churn into or out of a stock into a new stock, rather than thinking that I would keep on holding these sort of 10 Indian large companies forever into the future. That's not a good idea, because many of them might go out of business or go into a long decline as well.
Pratik, I see that we are at the close of the hour. Let's just take last few questions.
Sure. So we don't have any questions, I guess. Actually, we don't have any questions left.
That's brilliant timing then.
So anyone wishes to ask a question, or can just write in the chat or just hit the ask the question button. It might be looking like a call out icon on your particular device. It depends on your device, really, the kind of icon you have. Any questions or anything you want to add to the discussion, or any thoughts you have? So you feel free to share. I guess we don't have any. So I guess.
It's over.
Wait, let me wait. Okay, now it's fine. Otherwise, it would have gone until eternity.
For lunch.
Yeah. So I guess we don't have any further questions, or no one is actually willing to share their views as well. So any final thoughts, Vinay or Deven, before we end this?
So I would just like to say that there is a general tendency to think that because of the recency effect, that market is too high or low, and that is where the investor behavior starts to display trades wherein we are hesitant of entering or investing into the market only because of the fact that we think that market is too high, like right now what is happening right now. So the only issue with that is that there is no objective way to determine as to where the broader markets currently are. So my only humble appeal to anyone listening to this talk would be to uh, uh, just think hard and think about the fact that what is the way in which we can determine as to, I mean, there is no logical way to determine as to where the broader markets currently are, whether they are too high or low. So that is something that we should not worry about while we are planning to invest. And what we should worry about is that what is the kind of risk that we are taking, and how are we able to control that risk, how are we able to manage that risk, so that we can continuously be present. There was a lot of discussion about compounding in this talk. So actually the real compounding happens by just being in the market in the right set of stocks. So that is, I think, the lesson to take as per me from as far as the lesson of compounding is concerned, that you may need to continue changing your stocks from time to time, but the real compounding happens by just being present in the market and just being invested in the right kind of stocks as per your judgment.
Absolutely right. Just to add to that, when you talk about the most frequent question that we get is the markets are at highs. Is it good to invest or start investing now? So we have actually kind of removed that timing risk from our own portfolios, because our model portfolio is 100% invested as of now. We don't buy the entire 100% for any new investor coming in. So basically, we change the allocations depending on how much the stocks have run up and depending on their particular risk metrics that we internally manage through a proprietary sort of a method. So how it works is, so what it ends up doing is, let's say you have a max risk sort of a drawdown from the top, from our old investors. Let's say that is at 15%, which is the maximum loss you will see from the top. So we keep that same for everyone, irrespective of when he's coming in. So even if you come today, you will have the same amount of risk as the guy who had come in, let's say, a year earlier. It's very difficult to explain this over a call, but probably if you read this link, you would have a better idea, which I have shared in chat.
As far as I would weigh in with my 2 cents. I started investing in 2003. The first time I opened my account, the Indian Infoline broker said, invest with care. Nifty is about 2000. It's like lifetime high. You better be careful.
Yeah.
Today we know where Nifty is. And it's all about investing and doing it smart. So every day is a good day to invest.
Yeah, so that pretty much puts focus on the point that no one can really predict which way a particular index or country or any stock is going. You just have to be in the markets, be invested, take care of your risks, and have a good risk management framework, and let the process do its job.
Perfect.
Right, so
I think on that note, it's time, I think, is there a question?
Let's give, yeah, there are a few. So I think someone was raising his hand. His name is Akshay Bhardwaj. Yeah, you can speak now. Akshay, are you there? Okay, he may have left. Yeah, he's unmuted, but maybe he has left. So there are a few people in chat as well. Who's asking? Kiran is asking, while your investment strategy is active portfolio management of growth companies, if I may call it riding the wave with growth companies, do you also do a reverse ride the wave on decline companies by shorting? Yeah, you're right. We do that. But because shorting instruments are so limited in the Indian markets and the lot sizes are such, it requires a certain minimum sort of minimum investment size in order to short or use derivatives properly while diversifying our short portfolio. So that ends up asking for a minimum portfolio size of 1 crore or so. Hope that answers your question. Anyone else who wants to speak or wants to ask a question can just unmute themselves and just say. All right. I guess there are no further questions or no further comments, and I guess we have come to the end of an hour as well. So let's call it a day, I guess. And thanks for so many people who have taken time off on their Sundays to join us and hear three boring guys speak on markets, talking about boring. Yeah, but when you start talking about risk management, risk framework, processes, it starts becoming boring. People just want to see stonks go high. So that's not something that we do. That's the interesting part. So yeah, thanks for coming. That's all I want to say.
Yeah, and if you have any questions, feel free to contact us individually or through the EGC portal. Happy to engage you offline.
Sure. All right. Thanks for coming, and I'm just ending the meeting as of now.